All right, let's jump right into this explainer. Today, we're shifting our focus from this endless cycle of passive consumption to actually building a proactive wealth engine. Because let's be honest, we're so often told that getting wealthy is about, catching a lucky break, landing some massive opportunity, or just stumbling onto the perfect business idea. But the sources we're digging into today reveal a completely different reality. Wealth absolutely is not a lottery ticket, it's a system. So today, we are going to dismantle the systems that keep us trapped and map out the exact blueprint you need to build an engine that actually works for you. And we're starting with the ultimate question. Are you directing your finances, or are invisible habits silently draining your wealth? There's this very real yet totally invisible line in life. On one side of it, money dictates literally everything. It controls your time, your daily decisions, your stress levels, your whole future. But on the other side, you control the money. You decide how to spend your time, and you wake up without that constant, nagging financial dread. The crazy thing is, most people, even really high-earning professionals, spend their entire lives just inches away from crossing that line, but they never actually do. And it is definitely not because they lack intelligence or a solid work ethic. So why do they get stuck? Well, it's because they fall into a beautifully disguised trap. We kind of trick ourselves into thinking our job is our wealth engine. We wake up, we go to work, we earn our paycheck, and then we take 100% of that fuel and just burn it to survive. Rent, food, cars, all those little daily subscriptions that, make the day feel bearable. We fill the tank, and then we immediately drain it. It's a closed loop that keeps us incredibly busy and totally exhausted. Sure, as your income goes up, you might buy nicer things, but really, you're just surviving in an upgraded cage. You're generating all this motion, but absolutely zero forward direction. Which brings us to section 1, unmasking our invisible money scripts. Let's look at how just a simple $10 decision can show us the massive gap between a mindset of temporary relief and a mindset of wealth deployment. Think about it. When you're trapped in survival mode and you stumble on an extra $10, your brain immediately goes, okay, what can I buy? Why? Because in that stressed out state, spending gives you a quick emotional hit, a tiny feeling of control. But when you're operating in wealth mode, that exact same $10 triggers a totally different question. How can this make more money? That shift right there, it's a total game changer. You stop seeing money as just stuff to consume and start seeing it as soldiers to deploy. And this is where behavioral finance comes in, showing us just how predictably irrational we all are. Take the stock market, for instance. When we see a chart taking a nosedive, this thing called loss aversion kicks into high gear. Studies actually show that the psychological pain of losing money is twice as strong as the joy of gaining it. Factor in recency bias, where we put way too much weight on whatever the market just did yesterday, and suddenly we're panicking, buying high and selling low. We let our emotions totally hijack our rational self-interest. All right, moving on to part 2, the illusion of progress. So how do we fool ourselves into thinking we're moving forward? It usually happens through lifestyle creep, and it is incredibly subtle. You get a promotion, your paycheck bumps up, and suddenly, your standard of living just magically adjusts upward to match it. You eat out a bit more, upgrade to premium brands, maybe treat that tax refund as a shopping spree instead of an investment. In the short term, this quietly erodes your emergency savings and keeps you stuck paycheck to paycheck. But the long-term effects, they're brutal. You completely miss out on the magic of compound interest during your peak earning years. So why do we do it? Well, there are 3 deeply ingrained forces pressuring us to keep spending. First is survival pressure. When you're just trying to survive the week, your brain literally isn't wired to plan 10 years out. Second is that illusion of progress we just mentioned, decorating the upgraded cage. And third is social gravity. When your neighbors or coworkers start buying flashy things, you feel this massive, unspoken pressure to match them just to keep your social standing. Breaking away from the pack, that creates some serious tension. Let's dive into section 3, the fights and friction. It is wild how much energy couples waste fighting over tiny expenses while completely ignoring the huge wealth decisions. Financial expert Ramit Sethi points out that nearly half of couples argue about money, but they're almost always arguing about the wrong things. They'll go to war over a Target run or fiercely debate the price of a $3 turnip at the grocery store. But they completely ignore the $30,000 questions. What's our savings rate? What's our asset allocation? What's our actual vision for a rich life? We obsess over the pennies because the big questions just feel way too intimidating. And here's another huge friction point for couples. When incomes are vastly different, assuming a strict 50-50 split is fair is a fast track to resentment. I mean, if one partner earns way more, forcing a rigid 50% split on a lifestyle that they dictated can literally drown the other partner financially. A true partnership isn't about rigid equality, it's about equity. It's about adjusting those contributions proportionally based on what each person is actually bringing to the table. The sources also highlight this really specific cultural script that's still messing with relationships today. The old dynamic where men handle the big decisions, like investing, while women are relegated to just paying the day-to-day bills. Objectively speaking, restricting women from fully participating in major wealth-building strategies is just fundamentally flawed. Managing money shouldn't just be about keeping the lights on. It has to include strategizing, investing, and fully taking up space in the family's financial future. All right, let's hit part 4, opportunity, cost, and time. So let's ground all this psychology in some hard math. Every single time you spend, you're making a choice between having something right now and an unseen future alternative. That's opportunity cost. But human nature makes us focus only on the explicit trade-off, the stuff right in front of us. We totally fail to ask the implicit question, what future freedom am I trading away to have this thing today? $7,619. Let that number sink in. That is the compounding power of skipping just one $4.49 daily coffee and investing that $54 a month over 10 years at a super modest 3% return. Over $7,000? Look, our brains naturally pull us toward the immediate reward. But once you truly grasp the future value of your money, you realize that your tiny daily habits can completely dwarf those big, agonizing financial decisions over a decade. And that's because wealth isn't linear at all. It's exponential. At the start, investing a little bit feels kind of pointless, right? You put in $10, it turns into 11, and you think, ugh, why am I even bothering? This is exactly where most people quit, because the progress is basically invisible. But think of it like packing a snowball at the top of a giant hill. At first, it's tiny, it's fragile, but as it rolls, year after year, it picks up mass. And as it gets bigger, it gets faster. Eventually, you aren't even pushing the snowball anymore. It's doing the work entirely on its own. Which brings us to our final section, part 5, actually building your wealth engine. So what's the ultimate escape plan from the zero output cycle? It's changing your financial default settings. One study actually found that nearly 50% more people participated in their 401k when they were automatically enrolled. Automatically. By changing your defaults and automating your savings, you completely remove your own emotions from the equation. It guarantees your wealth engine gets its fuel first, way before you can be tempted by a flash sale. You literally make the decision to save disappear before you can even spend it. By following these 3 behavioral steps, you can override your own biases and finally take the wheel. Step 1, figure out the why. What emotions are actually driving your spending? Step 2, build a concrete plan that anchors you when the market gets volatile so you don't panic sell. And step 3, automate the whole shebang. Setting up an automatic recurring transfer ensures that your future self is always prioritized first. I want to leave you with this thought to chew on. Your financial life is an engine, and every single day you have a choice. You can keep burning all your fuel just to maintain an upgraded cage, or you can start directing your money into assets that actually produce energy on their own. So ask yourself today, is your financial engine building your future, or is it just consuming your present? Keep pushing that snowball, and I'll see you in the next explainer.